Good morning. Yeah, thanks for having me back. I always know that that's a good sign that I didn't blow it too bad in January when I was here walking you through the forecast then. So we're going to do a couple things today, which I have to do the obligatory economic update, but I do think that it's not just justification for my student loan, obviously, but also because the housing market is hugely dependent on what happens in the economy. So we'll go through that stuff, and it's mostly good news on the economic front. And so I will talk about some of the red flags that you may have read about in the newspaper. People are trying to freak us out, right, that a recession is impending. So we'll talk a little bit about those red flags, but ultimately why we're still fairly optimistic. We will talk about the housing market, and I'm finally here with good news, which hasn't been the case the last couple of years, but it does look like the effect of low rates has finally started to kick in. We are seeing some uptick in home sales. Now, we don't want to pop the champagne corks, obviously, because I do think that some of our kind of old friends are starting to reemerge again, and we'll get back to some of those familiar themes, but also I don't think we need to panic either, like some of those newspaper headlines might have us believe about either the economy in general or the housing market specifically, and so I'll talk a little bit about why I'm maybe a little bit more upbeat there. I do want to talk about selling home ownership, though, because I do think that one of the things that we are going to be having to overcome as we enter 2020 and beyond is kind of the consumer confidence element of things, because whether we kind of acknowledge and buy into the newspaper headlines that are fairly scary out there, the fact is that our customers are and our clients are, and so I think we're going to have more of a job of not just selling the home, but having to actually step up and sell the home ownership, because I think and I'll talk about this a little bit more later, but I think we got into a mode after 2008, 9, 10, where people are looking at their housing investment, kind of how they're looking at their E-Trade account or whatever it is, and they're trying to time the market and buy low and sell high, really worried about what's happening with prices over the next year or two, and kind of forgetting about the real reason why home ownership is so important. And so I want to kind of arm you guys with some of those arguments of why home ownership is so important and what they can ultimately get out of it to try and refocus that conversation and hopefully combat some of this kind of consumer confidence, or what I call jokingly call the brother-in-law effect, where you hear people's brother-in-laws all the time are telling them scary stuff about the housing market, right? And then I'll wrap up just with a quick overview of our forecast, which we just released earlier this month down at Reimagine, and I know they said it was better in the press release. I'm saying that it's less pessimistic. It's a minor distinction, but I do think that we still have, even though we are more optimistic, there's still a lot of challenges out there, and I want to be upfront about that. But bottom line is we do see more sales coming down the pike and prices that continue to grow. Again, ultimately going to be a market, though, that's starting to be governed again by supply, I think, and that's been a kind of familiar theme right up to the beginning of 2018 when we started talking about the market shift. Now it looks like we're kind of getting back to normal, if you will. So let's talk about the economy first. The economy is still growing, so we grew by about 2%. In the second quarter, we don't have the third quarter number yet, but it does look like it's again going to come in about 2 to 2.5%. It's largely still a consumer-driven show, though, and so that's good. While unemployment is low and consumer confidence is still fairly high, but we don't have a lot of other eggs in our economic basket, if you will. We don't see a lot of growth coming out of the business sector, right? They're not building a lot of new commercial structures. They're not investing a lot in either new IP or new equipment, software, and productive capacity. And so, while consumers are riding high, things are good, right? But when consumers decide to take a step back, we don't have as much to fall back on after that, right? So again, consumer confidence is still high, so this is still a positive, but it's also a potential risk factor, just because again, we have all of our eggs kind of in this one basket on the consumer side. The good news, though, is that the labor markets are still very strong. I don't know why I didn't update that to September. I have it on the next slide, but job growth continues to truck along at about 1.6%. Unemployment is still at very low levels. In fact, I think, unemployment is at the lowest levels in over 50 years. In fact, California, you can only really get good data going back to 1976, but we're at the lowest level of unemployment at any time since then, and likely even farther if you could get good data going back even farther. Of course, that's true all across the state. So those are the September numbers, and here in Bakersfield, we're at 6% unemployment, which is the second highest in the state by the standards of the rest of the metropolitan areas, but it's a very low number. In fact, if you kind of I brought the long-term history on this because I think it's really important and kind of underscores why we don't need to panic despite all those scary newspaper headlines, because, do you guys know how far back in time you have to go till you get a 6% unemployment in Bakersfield? I don't either, because the data only goes back 30 years, but it's the lowest for the years that we can get good data. So we're, even here at very low levels, and look at the improvement, right? If you go back, people say that there's still a lot of markets with 6, 7, 8% unemployment in California, but if you go back to the height of the recession, we're clocking in at almost 18% unemployment. So we've reduced that, dramatically over the course of the last, 10 years of this expansion. And so, when folks say that it's just, Silicon Valley creating job growth or things like that, no, this is happening right here on the ground. And in fact, we're at, the lowest level of recorded unemployment here in Bakersfield. That's good, right? When people are working and they're making money, that's a good thing from a housing market standpoint. The other thing is, and I always kind of joke about how my dad used to brag about his 12.5% mortgage rate back in the 80s. That's the only reason why I bring this kind of 50-plus year history on interest rates is to kind of, again, speak to some of that consumer confidence issue out there that, look, rates are still, for all intents and purposes, at all-time low levels. It's a great time to use someone else's money to invest in real estate, right? It's very affordable, and yes, we're not at kind of the all-time low levels of interest rates when we got down to like 3.3, 3.4%, but in the mid 3% range is kind of prime time, and I don't see rates going much lower than that, although you would expect them to drop maybe a little bit lower, maybe to like 3.5. We have seen them creep up over the course of the last couple of weeks, and I'm not exactly sure what's going on there because the 10-year bond rate is still low, and so I'm not sure exactly where the risk is on these mortgages. They're still mostly government-backed, so if you have any feedback on that, I would love to hear it, but the important thing is that we don't see rates going, very much higher either. And that makes a big difference. In fact, rates are probably the one kind of nerdy, esoteric thing that I get to talk about where it's actually something, kind of where the rubber meets the road in terms of what we do in our business. Because if you look on the left-hand side, you can see that a year ago, we were basically at 4.6% for mortgage rates, and that was when actually sales really started to slow down dramatically. That was like a 100 basis point increase. But as rates have kind of slowly ticked down, what I'm showing you on the right-hand side here is the growth in the median home price, and you can see that home price growth has slowed a bit. So this kind of dark bluish line over here on the right is in those kind of low single digits, right? 2, 3, 4% price growth. But when you actually put that price growth together with the fact that rates are lower, this light blue line represents the growth in the monthly mortgage payment on the median priced home, right? So that takes into account these lower rates. And so even though, in September, the median priced home was actually 3% or so higher than it was at the same time last year, because rates have fallen so much, the payment on that home is actually cheaper than it was last year. So you have a cheaper payment, even on a more expensive home, and we know that affordability and obviously lack of supply that drives that is really the name of the game. And so the fact that your clients out there can actually either, this is a purchasing power thing, so they can either offer more on that property that they want to get and still have, the same exact mortgage payment that they could afford this time last year, or they can potentially buy a bigger home or whatever, or save some money. And so again, for those people who are kind of on the margin on being able to afford or want to have that little bit more competitive offer, we're still very inventory constrained, right? And so this gives folks a little bit more purchasing power to make sure that their offer gets accepted, or at least that they're not paying more money for the same home. and you can kind of see that here, right? And this is kind of both so I worked that same exact chart out, but just in terms of monthly payment on that median priced home. And you can see that, yes, it was about $2,400 a month at this time last year. Now it's about $2,200 a month. And so that's $200 a month, either, in folks' pockets, or they could potentially offer a higher number and still come in at that original $2,400. That's a huge thing for folks who are right on the bubble in terms of being able to afford home ownership, but it also, I think, represents kind of some of the ongoing challenges that we're going to have, because yes, it's great that folks are saving $200 a month on that median priced home, but unfortunately there was a lot of folks at $2,400 who couldn't afford, and there's still a lot of folks who can't afford at $2,200, right? And so yes, I think that this will help get some people back into the market, but we still have that kind of fundamental affordability issue that we need to work on over the long term, and Sacramento and at the local level through advocacy and really start to chip away at the supply issues. But overall, this is kind of beats the alternative, right, where folks just have to spend ever increasing amounts of their monthly paycheck just to be able to become homeowners. So, and you can see that that's true all the way across the state. We've had a little bit more price growth here in the Central Valley, and so we haven't had as big of a reduction. We don't have the biggest right in the Central Coast. I live over in Atascadero, and we haven't had as much price growth of late, and so those rate reductions have really had a big impact on monthly payments. But true all the way across the state. In San Francisco, it's especially true because prices are actually starting to fall in San Francisco. And you can see that on a percentage basis, again, saving 5% on your monthly mortgage payment is for some folks absolutely critical because of how hard affordability challenges still are. And so I do want to point out those kind of negative, pessimistic things. I don't know if you guys read this, but in my kind of nerd alert, the Google alert that I have set up on econ stuff, this was like, blowing up my email a couple of weeks ago because they said that the yield curve inverted, right? The yield curve inverted, that means that a recession is coming. And yes, you can see that actually the yield curve was inverted. And what the yield curve is, super nerdy, economics concept, but basically what you're doing is you're looking at longer term interest rates compared to shorter term interest rates. Theoretically, you should get paid more interest on a longer term investment. If I'm going to give you my money for 10 years and have it locked up with all the risks that you go out of business or what have you, I want to be compensated for that additional risk versus loaning you money for a year or 2 months, much less risky, right? I know where you're going to be a month or two from now. And so rates for longer term products, right, instruments should be higher. When they grow, when the yield curve inverts, it means that those interest rates over the short term are actually more. You're getting paid more money to loan someone money for 2 months than you are to loan it to them for 10 months, or for 10 years rather. That's historically been kind of batting 1,000 in terms of predicting a recession, right? If you go back in 2006, you can see that the yield curve was inverted for a while. There was a lot of short-run risk in the economy. People were worried about a recession, and so even loaning for 2 months, they really wanted to be compensated for that risk that they were taking, parting with their money. If you kind of zoom out, and this only zooms out just to the last recession, you'll notice that the yield curve inversion looks a lot less noticeable, right? You can kind of barely see it down here on the right-hand side. So we don't have this kind of sustained yield curve inversion where short-term rates are just paying so much over an extended period of time consistently. The other thing I would point out is that, yes, in general, the yield curve is kind of batting 1,000 in terms of predicting recession. So all these gray bars are all the various recessions that we've had going back over the last 5 or 6 decades. And yes, you can see, when the yield curve inverts, then generally sometime over the next 12 to 18 months, a recession has happened, right? But I'll point out again that you really can't see the yield curve inverted when you kind of zoom out to a historical standpoint. You can barely see those days of negative interest rates down there. The other thing is they don't always precipitate a recession, right? When we had a little baby yield curve inversion back in 1997, we we did not see any recession until 2001, when we had a much more sustained yield curve inversion. So basically, the moral of the story is, like, forget those econ nerds who are focusing way too much on this yield curve inversion. There's no evidence that there's a massive impending recession on the horizon, right? So again, probably best advice I can give you is, like, cancel your newspaper subscription, right? And just don't worry about those scary headlines. Unfortunately, though, how this is all playing out in the housing market is kind of more of the same. You did see almost a 6% increase in home sales in California, so we are more optimistic now, and you can expect that those low rates should help more buyers kind of get back into the market. But if you kind of look at the chart, right, that 6% growth doesn't really add up to a significant resurgence. We're still basically hovering at the same kind of 400,000 level, and when you kind of put it all together with the kind of steep declines that we had at the end of 2018 and into the beginning of 2019, when rates were 4.5% or so percent, you put that all together, we're still about 3.1% below where we were through the first 9 months of the year. So yes, optimistic, and we've seen these kind of short run increases in housing transaction, and in fact, it's the biggest growth that we've seen in almost 3 years, right? And you can see that as those rates started to go down, we really saw the pace of declines start to slow, and over the last 3 months, we've actually seen an increase in the number of home sales. And so clearly, rates do have an effect, and it's actually happening all across the state. We were one of the fastest growing regions in the state last month, and I think that again kind of really highlights the affordability dynamics in the market, where these more affordable areas tend to do a little bit better because folks just simply cannot afford to live in some of these denser employment centers where home prices are in excess of $600,000-$700,000. Again, I mentioned that we had a little bit better showing here. We had almost a 12% increase locally last month, and we've also been up for the last, for the last 3 months in a row. But again, if you kind of take a step back and look at the broader picture, we've basically been hovering at a kind of consistent level of home sales. Even with this good economic growth and those kind of lowest levels of unemployment, in Bakersfield's recorded history, that still hasn't translated through into growth in the housing market. And so that's why I mentioned at the beginning that kind of some of those familiar themes are starting to reemerge after the last kind of year and a half worth of market rebalancing. And I think that we're going to start to see these kind of supply constraints start to play a bigger role again as we move forward. You're starting to see the top end of the market rebound, and so again, this is one of the things that's got me more optimistic. I think the financial market volatility that we had through the first 6 or 7 months of the year was really not good news for the upper end of the housing market, but we do see that some folks are at least starting to come back, partly because prices are getting weaker at the top end. You're seeing more discounting and things like that. Not here locally. Actually, the top end of the market here locally is getting stronger. Unlike the rest of the state, but in general, we've finally seen some rebound statewide in the numbers. Here, over 1 million was actually down. That's a handful of sales, but if you look at 500 to 750, we had a double-digit increase locally. But you see this kind of same tale of two markets, right, where you have the bottom end of the market that's down because of a lack of available inventory, right? Simple as that. We don't build enough housing even here locally. And the top end of the market is kind of slowing but rebounding now, but for different reasons. That one's much more driven by consumer confidence and also just kind of wealth effects when the financial markets are kind of jumping around 500 or 600 points, every day. It's like I, also want to kind of cancel that financial market newspaper too, just because the stock market's going crazy. But I think that as things have settled out there, you see the top end doing a little bit better. And here's what it looks like. These are sorted by size, so biggest to smallest in terms of the local zip codes, and you can see that the big declines are in these markets that had less transactions. I think there was 65 closed sales in that 93301. I still need your guys' help to name these, come up with some clever, more descriptive names for these zip codes. But it is interesting to look at across the region that for the most part, most of our bigger markets did have increases in September. So that's a good sign that the growth is more broad-based than just kind of hanging our hat on any one particular local market. Also, I see folks taking out their phones. I sent the slides to Miss Linda, and also they're up on our website. So if you guys want these to use for whatever, you can go ahead and download them or email me or whatever, and you can have all this local data. The other thing I'd point out that has us optimistic is that pending sales continue to go up for whatever reason, and I think off-market listings and other things might be part of it, but pending sales hasn't been the best predictor over the course of the last couple years. You don't see a lot of correlation between pending and closed sales, but the last couple months it's started to really sync up better with the closed transactions. As you can see, we had that deceleration and then 3 months of growth. So pendings are still up, and that suggests that home sales will probably continue to go up as well, hence the kind of upward revision to our forecast for the housing market, right? We are more optimistic, but, you know, again, as I mentioned, our old friends of lack of supply are really starting to reemerge and start to dominate the show again. And so you can see that the market is tightening back up. If you go back to January, February, March, we were still in this kind of double-digit increase in the number of active listings mode. That really started to slow as we got into the second quarter, and lo and behold, throughout the third quarter, we've seen the number of actives actually starting to fall, right? So there's, again, back to this mode after a rebalancing where there's, you know, not going to be enough supply out there for the people who want to buy with all these low unemployment rates and rising income, et cetera, and we're back to a mode where there's going to be, again, not enough supply out there. So I think probably in 2020, my outreaches and my talks like this are going to start to sound a lot more like how they did in 2016 and 2017, even where, you know, low inventory was the name of the game. And you can see that, right? We had this kind of huge increase, the surge in actives where they really started to grow by 10, 20, and then by the end of 2018, like 30, 35% on a year-over-year basis. But that really started to dry up again as both sales started to come back and rates went down. And, you know, honestly, I view this as more of a rebalancing, right? When listings were going up by 20%, the newspapers, again, were saying that this is the mass exodus, right? That everyone's leaving California, and there's plenty of anecdotes about that. I, you know, went to my neighbor's garage sale the other day, and he was like joking that he was leaving California to go to Arizona and visit all of his old buddies that he went to high school with who have already kind of left California. And there is some of that going on, but this is not a mass exodus. This was a rebalancing back to the kind of new quote-unquote normal of about 3.5 months of supply from that abnormally low level of 2.5 months that we were at before. So this is both kind of a positive sign in the sense that it doesn't represent this kind of mass exodus from the housing market that we had last time, right before we had like 40 and 50% declines in home prices, right? So for those brother-in-laws who tell you that prices are about to tank, you're not seeing the huge kind of increase in active listings that we saw that precipitated that last time, but it's also kind of a negative in the sense that, you know, this is what we need in order to sell homes, right? If they're not available for sale, then there aren't any closed sales, obviously. We actually never even saw that kind of pop that you saw in the rest of the state, right? So if you look at active listings here in Bakersfield over the course of the last 3 years, we never got that 20 and 30 and 40%. The best that we could say was that active listings stopped falling in 2018, right? But then, you know, as the economic uncertainty has kind of sorted itself out, or at least the rates have gotten lower and home sales have started to pick back up, what you see is that we're back into the kind of double-digit mode for declines. And so that lack of available inventory in this market is going to be particularly acute, especially with those abnormally low levels of unemployment and continued economic growth. There's just not going to be the kind of outlet valve, right, the supply valve for all this demand that folks still want to buy these homes out there. And so even with these low rates, and I think partly that's why we don't see this big spike in closed transactions, even with these low rates, is just that there's nothing out there, especially for these first-time home buyers to buy. And you can see this, right? So, you know, we were down at kind of the low 2 2 months of supply range back in 2017, 2018. This is not the kind of mass exodus where you get up into 14 months of supply because there's this flood of new listings of people jumping ship, right? This is just clearly getting back to that kind of, again, new normal of about 3.5 months of supply. So again, that's a good sign from a kind of what's the trajectory of the market standpoint, right? That there isn't this big precipice or this big cliff that we're standing on the edge of. But it also means that we're in a market of 3 months of supply and very tight to get folks into actual closed sales, especially, again, where we need it the most, right? So those double-digit declines in actives are coming basically under 500,000 or under 750 statewide, and you see basically that similar pattern. I don't know why these turned white, but you see the same pattern here locally, where it's basically the kind of entry-level homes that we really want to get folks into that are in decline by about 22%. So a lot of these folks have jobs and are making money and want to jump on top of these low interest rates. And that's the problem that they're coming up against. And in fact, when I show you in a second, I think I have it now, but the market competitiveness has started to tighten back up, right? So we're not seeing, this increase in time on market or discounting that we were seeing earlier this year. And you can see in California, we ran up from about 13 days as the median time on market, right, to about 26 or 27 days. It's since dropped back down to about 24 days, but time on market was clearly starting to pick back up as that buyer demand and that buyer fatigue set in. And that's particularly true at the top end of the market. So, this is super nerdy, but these are just percentiles. So I broke the market up into price buckets so that, I can look at the top end of the market in Bakersfield together with the top end of the market in San Francisco without setting like a price threshold. You don't need to worry about all that stuff. What you need to worry about is that the most expensive housing stock are the ones that are having the biggest increases in time on market. So even though we're starting to see this rebound, and perhaps because we're seeing a rebound in the top end of the market, it's because the prices are coming down and folks are discounting again to kind of get these properties moved, right? Not so much the case here, actually, and again, because we didn't get that local pop of 30% in the active listing side, the best we could say was that listings were flat there for a while. We never saw the erosion in market competitiveness, but if you look at where we are today at 17 days as a median time on market, this is like basically in wintertime right now in September, right, where we're already starting to get into the seasonal lull, and you can see that, for the most part, last quarters of the year tend to be, the slowest in terms of being able to move homes quickly. We all know that from practice, and so it's even more remarkable that we're still at 17 days locally as a median time. The market is still very competitive. So again, this is good for keeping us encouraged that the market's not about to tank, right? But it's also discouraging because for those of us that are working with buyers, the homes are still moving super fast and there's not enough of them, right? And so just depends on where you land on that side of the equation. We are seeing a little bit more discounting statewide. So 98.5% was the median sale price to list price. That means about a 1.5% discount. Here locally, we're still clocking in at 100%. And what's interesting here, as I mentioned, is that the top end of the market is actually tightening in Bakersfield. And I think this could partly be some spillover effect, right? That folks who are buying at the top end of the market might be wanting to buy at the top end in more affordable markets to really plant their money somewhere safe in a growth market that they can kind of come back and get it in 10 or 20 years. And that's why you see, less discounting and less time on market at the top end of the market here, whereas we're not seeing that in places like LA and San Francisco. Like, people are in some cases leaving the top end of the market in these most expensive areas. And so, this might be a little bit of a short run benefit, but it's true all the way across the board, right? Even at the low end, our market is tightening and getting more competitive. So great if you're on the sales side and you got a bunch of listings, on the MLS right now, you can expect to move them quick. If you're working with buyers, it's kind of going to feel like 2017 again, where it's harder and harder to get them into homes, multiple offers, etc. And here there's no real discounting to speak of. You can see at the top end in California statewide, there is some discounting, but only at the top end of the market. I think here locally, you can see that actually there's a little bit less discounting at the top end of the market. There's still some discounts, right? But they're discounting actually less than they were at the top end at the same time last year. So again, market is getting more competitive, and again, we're still at 100% sales to list price. So as long as you're pricing those properties correctly, you can expect them to sell quickly and come in, near full asking price. And this is actually the first time, so what I'm showing you here is actually discounting of currently actives, right? So the last stuff was like, what did it close at compared to what it was listed at? This is asking, of those that are still active, how many have reduced price? And actually, you can see it's still a fair bit, right? Almost 42% of active listings out there have had some form of a price reduction on the order of about 4.4%. But what's interesting is that September was the first month in almost 2 years where there weren't more actives that had been reduced than there were in the same month last year. So actually, this is the first time that there was fewer price reductions in September than there was a year ago in almost 2 years. So again, this is a market rebalancing, not any evidence of a market that's imploding. We would see those charts just continuing to go up. Same with the listings, right? If people were really jumping ship. So we got to be eyes wide open that the market is tight. It's going to be hard for our buyers. Our sellers don't have as much power as they did in the past, but it's also a far cry from what the newspaper headlines would have you believe, that we're on that kind of precipice. But, with the market tightening back up and market competition going up, you do see price growth starting to stabilize. So you did see an almost 5% increase. That's the biggest price increase in, I think about a year. And you can see that actually condos have gone down. So even though I'm still fairly optimistic, there are red flags out there. Last time around, condo prices actually started to go down, before what you saw in the single family side of the market. So not a huge alarm bell, but definitely want to keep that going. But if you look at the single family side, that's a sign of prices actually rebounding, right? That's a pretty steady uptrend in home price growth. So we're not worried about, you can kind of tell those brother-in-laws out there that they don't know what they're talking about. I do kind of want to have a bit of a moment of silence, right, for all of us who didn't go out there and beg everyone we knew for a bunch of money back in 2009 when we could have picked up, a fleet of rental properties at the bargain basement price of $114,500, right? But I think that this is the kind of message that you want to share with your buyers to overcome that consumer confidence stuff, right? Because if you would have got in at the bottom of the market, you'd have about $140,000 in home equity sitting there ready for you to kind of extract and make more real estate investments or do whatever else, send your kids to college, whatever. And I think that this is kind of where we need to get the conversation going, because this is the benefit of home ownership, right? It's that leveraged investment that generates wealth for your clients, not that I bought low and sold high and this was some kind of whiz-bang financial investment. And you can see that price growth has been much more stable here locally, again, because we didn't have that huge rebalancing on the listing side, that we're still growing in the 5 to 7% range, and that seems pretty poised to continue, just given the kind of supply and demand characteristics. You do see, again, some warning signs on the townhome side, but again, I think that part of this is a shifting away from these expensive markets where folks can't afford to live. So these are median prices, obviously. And so if you sell, more homes in the Inland Empire and fewer in Marin County, then that skews the median lower and makes these townhome prices, I think, look worse than they are. But when you do look at it on a per square foot basis, it does seem like price growth is going to remain kind of in this low single digit. So even though we have the market kind of rebounding a bit, I don't forecast us getting back to those kind of 10 to 15% levels of price growth that we were battling through in 2016 and 17. And again, as I mentioned, prices at the top end are actually starting to come down, right? So those luxury sales or second homes, vacation properties, what have you, aren't commanding those same prices that they were at this time last year. But again, the good news is that there's no evidence of an impending collapse. We look at listing prices, growth in listing prices, as a fairly reasonable, it's an okay predictor of closed sale prices. But if you look at where listing prices have gone, a lot of of the slower price growth that we saw earlier this year was actually reflecting the weaker growth in listing prices that was happening when rates were up at 4.5% or 4.6%. Now that rates have gone down, you saw listing prices actually bounce back earlier this year, right? And then lo and behold, that led to some uptick in closed sale prices. So if our brother-in-laws at the weekend barbecues were right, what we would see was that listing prices would be somewhere down here, right? So we don't see those major price reductions coming down the pike that would precipitate a big decline. The other thing is, and this is something I'm still need to rename. I called it market velocity, but I think I need to turn the naming over to the marketing folks to come up with something more interesting. But what I'm showing you here in this blue line is basically just looking at the housing market from a very simplistic standpoint, right? How many home sales were there, and how many new homes did we put on the MLS to kind of replenish the housing stock, right? So if we sold 50 homes, we want to put at least 50 back on the MLS. Otherwise, the inventory actually went down that month, right? And so what you can see is that this baby blue line does like a phenomenal job of actually predicting prices. Prices in housing still come down to just basic supply and demand fundamentals. And what you can see is that when this blue line goes up, right, that there was more homes sold than new listings we put back on the MLS to replenish it. In other words, the inventory went down, right? That is very closely followed by an increase in home price growth. Well, look what's happened recently as those listings have stopped growing so much and sales have started to come around. Market velocity started ticking up at the beginning of this year and is actually the highest that it's been in over a year, and prices continue to follow that path. So if you have friends or you read that newspaper article that say home prices are too expensive or overvalued, home prices are too expensive in California. There's no argument there, but that's a different thing than asking if prices are on the precipice of falling. We've always been unaffordable, and we're nowhere near those kind of historic levels of unaffordability at this particular point in time. And you can see the price growth is strong all over the map. I think this one is that kind of outlier, 93301. There was like 85 home sales or something last year and about 65 in that zip code this year, and some of them were more expensive, and that's why you had a 50% price growth. But my point, not that one notwithstanding, the point is that we're seeing pretty strong price growth, and like the transaction side, it's pretty broad-based across all of Bakersfield, right? And so, that's all good news. This is the first time I've been able to come out and talk about how, sales are going up, prices are going up again as well, and the sellers have a pretty good time of it, but there's still a lot of challenges out there, namely on the consumer confidence side, right? Every single time I do one of these talks, you always get someone who comes up afterwards and goes, yeah, but my brother told me the prices are about to tank. And you kind of see that backed up in some of these numbers, because we've been doing a Google poll of California consumers for a little bit over a year now, and pretty consistently, you see that backed up when you just ask the very basic question, like, is it a good time to buy, right? And I showed you my dad's, interest rates before and how low unemployment is and things like that. And even with all those good economic trends, you ask folks if it's a good time to buy, and they say no, right? Part of this is affordability, that they, maybe it is a good time to buy and I just simply can't afford it. But part of it is the kind of, newspaper effect, the brother-in-law effect, where they are drinking that Kool-Aid and thinking yeah, I do remember in 2007 when my dad had to foreclose on his house or whatever. There's a lot of that psychological scar tissue left over, which is why I kind of say we need to do more than just selling the home, but start selling the benefits of home ownership, because there is a consumer confidence element that we're going to have to overcome. Those folks are hearing that at their barbecues. They are reading those newspapers that say the yield curve inverted and a recession is impending and things like that. And there's still a lot of just straight up structural challenges, right? Forget about all the psychological stuff. Even though the monthly payment has gone down because of low rates, those homes are still more expensive. And so if you want to put down 20%, you need to come up with, obviously, more money. In Central Valley, it's about $3,000 more just to be able to make the down payment, the 20% down payment on the same exact home. Folks are already strapped to be able to get into housing. And so even though, that's great, my monthly payment is lower, but where do I come up with the extra money to put down, which is often the biggest challenge. And you can see, that's pretty consistent here as well. It's about $3,300 in Kern County specifically, right? And so again, affordability is already a challenge. Where do folks come up with this extra cash out, even if they want to get into the housing? And of course, inventory is still going to be a thing, right? We're still only at 3.5 months of supply, and active listings are actually falling here by double digits, right? And so even if they can surmount all those obstacles, then you got to find them a house, right, and get their offer accepted. And so that's going to be an ongoing challenge. And so even though we're optimistic, I'm just being real with you guys about some of the challenges, and that's without even talking about some of the other economic uncertainty that's out there. I talked about the yield curve. Other people talk about this being the longest expansion in U.S. history, right? We've never had a expansion last as long as it's going to, and that means that we're about to have a recession. I could go into all the reasons why I don't agree with that, but I think it's suffice to say that there's nobody out there with a stopwatch deciding when to start and stop recessions. You need something to happen to precipitate that. But there are some things that we do need to worry about on the economic front, and I think that whether we buy into all these things, and I could come up with good arguments against a lot of them, some of them are legitimate concerns, but be that as it may, we still have those kind of fundamental structural things happening. And so even though we're more optimistic, we still have to recognize that it's not going to be a picnic out there either. And so even though the headwinds have kind of eased a bit, or we have maybe more tailwinds is maybe the right way to put it now, that there are not enough tailwinds where you flip it in cruise control and expect things to kind of fall into our laps, right? And so I think one of the ways that we do that is through selling home ownership, right? Forget about prices over the next year or two. Are you in a good job and can you make that payment? Then get in that home and ride it to death, because the simple fact is that this is the one and only way that folks in America actually accumulate net worth, right? They accumulate wealth. And so if you look at, I think the median net worth for the typical family, across the board in general is about $190,000, but it's so telling when you split this up between people who own their own home and people who rent their own home, right? And this is inflation adjusted, so this is back in 2013 dollar equivalents, basically even back in the 80s. What you can see is that renters have never ever had more than $5,000 worth of net wealth, right? Whereas homeowners, yes, we were hit by the downturn, right? But the long-term trajectory, even after taking away inflation, is that this is the only proven way that people in America actually make money. So forget about buying low and selling high, and think about the wealth that you accumulate over the long haul, because this is what kind of leads to those intergenerational things. Look, my dad was a high school dropout. He worked at the parts department at the Chevy dealership down the street from where I lived, and the only reason why I'm here doing speeches like this or working at CAR is not because my dad was some super sophisticated PhD with all these connections, but because he owned his own home, and that provided both the kind of wealth cushion and also the stability where I could just focus on going to school and doing good in school or whatever. And that's that is the magic of home ownership. It's not that you bought low and sold high and did all this kind of whiz-bang financial stuff. No, it's that you got into a home, camped out on it, and made money. And that's where we kind of need that conversation going. The other thing is, every year your rent will continue to go up. When you get into a home, you are protecting yourself against rising rents, right? If you would have gotten into the housing market when prices were down at $114,000, guess what? You're paying the same exact amount of money today that you were in 2009, and you're going to be paying the same exact amount of money on a monthly basis going forward for the next 20 years, right? Whereas look at the kind of history of rents in California. If you think home prices are no picnic, just ask the young folks coming out of college how how expensive it is to rent an apartment near their job, and that number is only going to get worse because these are both symptoms of a fundamental supply imbalance here in California. And if you lock in that 30-year fixed rate mortgage, you set in stone your monthly housing costs. Your incomes are going to keep going up, the value of that property is going to keep going up, but your monthly payment is going to stay the same. And that's, that can't be understated as a value of benefits, or of home ownership rather. There's, these are just a couple of select, other ways that home ownership really matters for people. But basically, like me, even though my dad dropped out of high school, you're more likely to go to high school and get a high school diploma and a college degree if your parents did. But even above and beyond, controlling for your parents' characteristics and demographics and their income, etc., there's still a positive benefit on educational attainment above and beyond all those things, just attached to home ownership. So it's not just about your own pocketbook or doing better for your own net worth. This is an intergenerational thing, right? If you want, your grandkids to be the ones up here given this next forecast, then the best way to do that is to own your own home, right? And so we need to get folks focused on the prize, right? It makes folks more healthy. These are people who are much smarter than me. You always get the argument from people that, home ownership, house prices don't go up as much as the stock market, or there's other investments where you could do even better than housing. And I disagree with that. And I could go through all the kind of nerdy numbers, and I will do in a second. But I think it's worth reading from Harvard, who's much smarter than me, and they say that basically, while studies simulating the financial returns to owning and renting often find that renting can be more beneficial, in practice, right, and that was what I showed you in those net worth numbers, in practice, in reality, that's not what happens. So yes, on paper, you can come up with a financial model where I take the money that I would have spent to become a homeowner, and I do all this kind of whiz-bang financial investing, and after 30 years, I end up better off than what I would have done if I would have bought that house. That's not what actually happens in real life, right? And so that's what Harvard is kind of underscoring here. Renters never actually accumulate that additional wealth, right? They take that differential. They don't go out and do all these whiz-bang financial investments. They drive a nicer car. They live in a better apartment. They, buy that super nice watch that's going to impress that, person that they have their eye on or whatever, and don't actually end up improving their quality of life. And this is just a simple illustration for those people who tell you that you can do better in the stock market. They forget that the kind of biggest point about the housing market is that it's a leveraged investment, right? When you invest $100,000 into the stock market, you're putting up all $100,000, and so in order to get a $15,000 return on that investment, you need the stock market to go up by 15%, right? But when you take $100,000 of your money and put it in the housing market, you're actually making a $500,000 investment, presumably, or if you want to put down 3%, you're making an even bigger investment, obviously, than that. And so to get that same $15,000 return, right, you only need your home to go up by about 3%, right? Because the bank's not coming back and splitting profits with you on the back end. They're letting you use that money, and as long as you kind of meet the obligations of that mortgage note, that you get to keep all those profits, right? And so you don't need the home to go up as fast. And oh, by the way, you also get to live there too, right? And so, that's what I would say to the folks who think that you can do better with your money. There's no better way, and that's been proven through the stats. We need to get folks focused on the benefits, the long-term benefits of home ownership, and I think that that's how we succeed. Look, we don't control what the Fed does or whether the yield curve inverts or any of that stuff, but we do know that folks want to become homeowners. They're not educated about the low down payment loan options, and I think I talked about that when I was here in February, just how many people out there think you need 30+% of the home value in order to get into housing. So we can educate on that front about the means, the financial products that are out there to get into home ownership, and why you even want to get in there in the first place. And I think if we do that, we can be successful, because we do have the economy continuing to truck along, still at this kind of lackluster 2% pace, but given that we're 10% or 10 years into this expansion, we will take continued growth. Unemployment is going to stay tight. And here in California, we expect that that's going to mean, especially with rates continuing to stay low, so you can see that we still have rates basically hovering where they are now. We don't see a big reduction in rates down to like 3% or something like that, but I see them kind of maintaining this low 3.5 to 3.75% over the course of the next year, and that's why we revised our sales forecast to go up by about 1% in 2020. We did have that going actually down next year, but rates do have a big impact. The reason why it's not going up even more than that is, again, we can't pop those champagne corks because supply is still tight and we've still got those affordability issues, but prices will continue to go up by about 2.5% or so, and sales are actually forecast to increase in 2020. And so again, we can't really celebrate, but we can at least be more optimistic that we have some tailwinds. But I still think in much the same way as we needed to last year and in 2017 and 16 is it really comes down to individual effort and being that educator in chief and going out there and making it happen. This is definitely not a kind of cruise control environment, right? And so for me, the key takeaways are that the market has improved mainly because of low rates, and we are more optimistic now as a result. And price growth is actually stabilizing, right? So the Kool-Aid effect is still going to be out there. You're still going to have to overcome it with the facts, obviously. But at least the numbers are kind of backing us up that prices continue to go up. Of course, I still think that we have a lot of those affordability / supply. I probably should do that as a slash instead of a comma because they're really the same thing, right? The affordability issue is the supply issue, but they're still out there along with that Kool-Aid effect. And so I think that's why you still need to get out there and work really hard next year, and why it's still going to be difficult. But and I kind of jokingly don't say we're more optimistic. I say we're less pessimistic because I just want to kind of highlight that you guys are still going to need to get out there and do what you do best and really make it happen. It's not going to happen automatically, and I think one of the ways that we do that is to, again, kind of sell that home ownership. So that's what it comes down to for me. Super quick, shameless plug that hopefully helps you guys. We have all these new downloadable market reports. So if you're on like Facebook or Instagram, these are the Instagram ones. We have like monthly market overviews of kind of the basic stats that are happening here in the city of Bakersfield. This one's like in letter format. This is called our market overview report. It just gives a really quick snapshot. We also have this thing, which is like a buyer's guide, right? To, again, kind of address some of that lack of knowledge on the buyer side where, somebody in the market for a 3-bedroom home, which has a median price here in Bakersfield of $235,000, because of that kind of lack of knowledge. There's a lot of folks out there who think you need 20 to 30 or more % down, and they're going, they log into their credit union and go, yep, I don't have $47,000 in there, and then they log out and never contact a realtor. This kind of helps you have those conversations that in some cases you can get in with as little as 3% down, and coming up with $7,000 might be a lot more feasible for some of your clients. So we're trying to make you guys the market experts and also give you some of these things that can kind of help you have those conversations to kind of navigate this more challenging environment and overcome the brother-in-law effect. Find $7,000 somewhere and don't miss the next 10 years of home price growth that I showed you earlier. You can also come nerd out with me on the Housing Matters podcast where we talk about the Fed or the market or whatever else. We have a lot of cool guests coming up next year. You get that wherever you get your podcasts. But more than anything else, thank you so much for having me back. They didn't pull out the shepherd's hook, so if you guys want to ask some questions, I'll try and answer them. Yes?
What's your opinion about the current political climate? Obviously, we're coming into the election in 2020. Do you find there might be a correlation between the consumer confidence there and their way to see whether or not the market is going to shift in a certain direction, or is it strictly a supply side issue?
Yeah, I don't think that's a big deal. We looked at this. If you guys remember, we had a fairly contentious election in 2016. So we did actually go and look at the effect of presidential elections back in right after the last election, and we really couldn't pull out any discernible impacts. Once you do see some impacts in presidential election years, but once you control for what was happening in the economy with interest rates and unemployment at those times, there was really no effect, which kind of makes sense. The president isn't really impacting the kind of day-to-day, nuts and bolts of the housing market. It just comes down to whether folks are working and whether there's homes to buy and are rates affordable. So there might be a slight slowdown in the kind of couple months preceding the presidential election, but even that wasn't statistically significant. So for me, I think it's really about the kind of fundamentals that are happening out there. I wouldn't worry too much one way or the other. Why isn't the Fed lowering mortgage rates? I mean, the Fed only really controls overnight borrowing, and I think that in our, the Fed's the easy thing to keep an eye on, but long-term rates are really set by global financial markets. So, and there we still have this kind of glut of savings out there, right? Not in America, unfortunately, but you have all these developing countries like China and Brazil that are kind of coming on board with all kinds of new wealth. That wealth needs a home, and it tends to come into the United States, and that keeps rates low on the long end. And when the Fed does something, it doesn't really have much impact on the long end of the yield curve. We need to see even more capital flood into the U.S. to drive down those long-term rates. And I think, unfortunately, unlike the U.S. economy, which is more stable, the rest of the world's economy is still kind of all over the map. And so the pace of that wealth creation pumping into long-term securities basically isn't there to push them any lower than they are. I mean, why the spread between 10 years and 30 years are still high, that I don't know, because they're, where's the additional risk? They're still largely backed by the U.S. government. So I expect that over time that will wash out, and that the 30-year will start to look more like the trends in the 10-year, but they're still pretty low right now. Yeah. Sir.
Yeah. So thank you for.
Thank you.
This talk. I just was wondering. I mean, I was speaking to other agents, and I just wanted to get your expertise on, in terms of whether or not it's a flipping market for clients here in Bakersfield, especially if the appreciation rate is pretty low. It's not double-digit.
Right. Yeah, we did have, I think, double-digit growth in transactions, but still mid-single price is still good. And I think that from a flipping standpoint, it still comes down to supply and demand, and there's not a lot of inventory out there. People want to buy homes. If you can buy it and fix it up, I think that you can expect to sell it quickly, right? Because those time on markets are still fairly low and not much discounting. And then when you look at the broader economy, we're still generating jobs and at that kind of lowest level of unemployment in 30 years. And so I think that the market for those entry level homes that you'd want to flip is strong, and you can sell those homes quickly. Unfortunately, I showed you the price graph too, right? So you're getting them at basically close to all time high levels of prices, but that's as long as you can make more than you put into it from an investment standpoint, then that's kind of irrelevant. Yeah, I think it's still a great time to be an investor in real estate regardless, right? Because the rental market is as tight as ever, and rents are poised to continue to go up even with this rent control. You have that leveraged investment and rents that will continue to go up, and I think the same thing is true on the flipping side. If people want to buy those homes and prices are high and you can get in and make it happen, then that's always a good thing. Back. We're better. We do a better job of getting new permits online, but unfortunately, it's still not enough. Point number one, and point number two are our supply issues being exacerbated by the affordability that we have. So in some ways, like, our biggest strength is also our biggest weakness, because you unfortunately have a lot of folks in places like LA and Orange County and look at the median priced home of $800,000 and go, what, forget that, and come to places like Bakersfield where they can get a really nice 4-bedroom house or whatever in the $400,000 to $500,000 range, and so we'd not only have to accommodate our own kind of domestic population base, but then you also have this uptick in demand from people who are kind of, the housing refugees from other parts of the state. So we build more pound for pound than other areas, but we're also starting to need even more because, the population growth in places like San Francisco and LA, that's not where people are going anymore. So we're doing a better job, but we can't sit around and pat ourselves on the back because there's still, unfortunately, a lot of work to do. Yes, sir.
What do you think the impact on supply will be rent control?
Well, I think we'll start to see it already. I think you're already seeing it. If you look at the newspapers, there's already a bunch of evictions and stuff happening where people are trying to get ahead of the curve. And so, rent control could be a whole hour-long thing, and I think for the people who are lucky enough to get into a rent-controlled unit, yeah, it must be great for them to have that rent-stabilized unit. Unfortunately, it doesn't always help the intended population, nor does it address the kind of root cause. Prices for rentals are high because there's a lot of people who need rentals and not enough rentals, right? And so making rental property less profitable doesn't kind of suggest that the solution is coming down the pipe. But there's not a lot of nonprofit developers out there that I know of. And so, these guys got to be able to make money off this stuff. And again, everyone kind of wins when there's more housing supply, right? We have a better economy. The developers make more money. We can sell more homes, obviously, because there's more housing transactions. And so, I think you're already going to start to see fairly quick when it comes to new construction permits. I think in 2019, actually, we are poised to have fewer housing permits than we had last year. And last year, we were running about half the pace that we actually need just to be able to even tread water on housing affordability. So, yeah, we were doing a not good job of building already, and I think this makes it worse. Yeah. Did I beat you into submission?
Yeah, pretty much.
All right. Thank you, guys.